If you own any kind of real estate or you're just thinking about how you can maximize your generational wealth plan, this is going to be a must-watch video. I'm going to be diving into a commonly debated topic, life insurance, and how life insurance fits into the overall picture as a very important piece to make sure that you reduce your risk to your family and also reduce cost of certain expenses that need to be paid upon death when you own real estate in your portfolio. This is going to be a bit of a longer video, so before I get into the specifics, I'll just give you the Coles Notes right now. We're going to be talking about life insurance as a way to protect your family from two things: debt owing on a property when you pass away, and taxes that may need to be paid, particularly when you own an investment property in Canada. So we're going to be looking at some numbers to look at this objectively. I'm not just giving you my opinion. I'm going to show you the actual numbers of two scenarios, okay? In scenario one, if you own a property without life insurance, and scenario two, if you own a property with life insurance, and the difference at death at a certain age, which is the better decision. This is not me telling you to buy life insurance. I'm going to let you make that decision and just show you the numbers so you can see where I'm coming from. Let's dive into it. Okay, so let's start with the first example, taking a look at the situation with a principal residence. So when you pass away with a principal residence in your name, there are no taxes applicable at death. You can actually transfer property that you're using as a principal residence onto your kids tax-free. In this scenario, we've assumed that the individual is buying the property for $500,000 this year, and they're putting 20% down, so their mortgage balance is $400,000. We've assumed an average 4% interest rate on this. So we're keeping the monthly payments the same throughout the life cycle of this example that we're looking at. So assuming a 4% interest rate, the monthly payments work out to about $25.47 and 41 cents. On the right-hand side is the most important column, looking at the actual estate value in this scenario. So the main consideration that we're looking at here, which has a major impact on the estate value, is how much of the mortgage is remaining when you happen to pass away. So here we're looking at a 15-year example, so between 2025 and 2039. And as we can see, the estate value really climbs as you continue further on in the life cycle, of course, because we have appreciation of the property, assuming a growth rate of 4% per year, as we can see here. And the mortgage balance is declining because we're making our monthly payments, paying off some of the principal as well as interest. So the largest impact and the most important time to own life insurance is earlier on when you first purchase your home. Once you've completely paid off the mortgage balance, if it's a principal residence, there really isn't a need to have life insurance because there's not a whole lot to cover. If there's no debt on the property, the life insurance is irrelevant. When there is debt, that's when you really want to think about what the impact might be to your family if you happen to pass away and you want them to inherit the property without having any financial burden associated with that property. So think about your spouse, think about your kids in this scenario. If you don't want them to have to worry about the mortgage, then life insurance is definitely something to think about. So let's take a look, okay? So in this example, let's take a look at the monthly payment difference, first of all, when you do cover the property using life insurance. And we're using the same numbers here, same property value, same mortgage balance, okay? The only difference here is we're assuming that it's about a 35-year-old male, non-smoker, and the monthly payments for life insurance work out to about $50 a month. So instead of our payments per month being $25.47, they now increase to $25.97 because we're covering the property using life insurance, equating to $400,000 of coverage, which will cost us about $50 a month. If we take a look at the change in estate value, we can see that the estate value is much larger earlier on in the life cycle here. So if we take a look at if the individual were to pass away in the current year, the estate value is basically the same as what they purchased the property for because the mortgage gets paid down immediately using the life insurance coverage. As we get later on in the coverage, 15 years down the road, if the individual happened to pass away, now the property's worth $900,000, the mortgage balance is $166K, and we still have the life insurance coverage. So now the estate value really climbs to about $1.1 million. So when we're thinking about maximizing generational wealth, the answer is pretty obvious here. Obviously, the risk of dying earlier on in your life is not a high risk, but what we have to think about is the financial impact if this does happen, because the probability of passing away at age 35 is not zero. So if you want to protect this risk, it might make sense to consider life insurance, especially if you look at the numbers and you're looking at attempting to maximize the estate value. Okay. So what people often ask me in comparison is, what if I instead invested the $50 that I would have or could have spent on life insurance? So let's take a look at that. So if we take a 15-year view, and let's just use 2039 as an example. So if we're using life insurance coverage and the individual passes away, at age 50, the estate value works out to $1.13 million in this case. So let's take a look at a comparison. If $50 is invested in the markets inside of a TFSA where there are no taxes applicable on the growth of that money, what happens? So if we assume a 10% annual return, okay, $50 a month works out to about $600 a year. So if we add 10% on an annual basis, and we take a look down at year 2039, that investment account is estimated to grow to about $23,726. Okay. So pretty big difference if we consider $50 invested versus $50 used to purchase life insurance instead. You spend $50 a month and you get a $400,000 payout if you happen to pass away during the lifetime or during that period. In comparison, you're going to have to save a lot more money and invest a lot more money in order to grow your money to $400,000 in 15 years. So if you look at it from an ROI standpoint, of course, it's a challenging thing to think about ROI when you're thinking about your own death. But what we're doing is talking about maximizing your estate value and protecting if something happens earlier than expected. Now, if we take a look at the overall estate value, and let's say, we assume the individual passes away at age 50 in year 2039, we're comparing an overall estate value of $757,000 compared to $1.13 million if the individual bought life insurance instead of investing $50 a month. Okay. So this is really black and white, guys. I'm just showing you the numbers and the decision is yours. When we're talking about a principal residence, especially when you have a family, if the goal is to keep the asset within the family with no financial burden, you may want to consider purchasing life insurance to protect your mortgage. Okay, now let's take a look at investment properties. This is a little bit more complex because now we have to think about taxes, okay? Mortgages are still in the picture because often people buy investment properties using debt. They leverage that debt to rent out the property to a tenant, which is great to earn some cash flow. But now we got to think about investment properties and the capital gains taxes that are applicable upon death, okay? So we'll use the same time period here. We're going to take a look at a 15-year period, assuming the individual passes away at some point at age 50 or prior to age 50. So if we take a look at 2039, okay, the way capital gains taxes are applied is they use an inclusion rate. So anything under the first $250,000 is going to have an inclusion rate of 50%. Anything over that $250,000 is going to have an inclusion rate of 66.67%. Okay. And what that inclusion rate is, it's basically just specifying how much of the capital gain position is going to be taxed. So if we take a look at year 2025 as an example, let's say the property is purchased for $500,000, grows to $520,000 by the end of the year. The mortgage balance is $400,000. So if the property value after 1 year is $520,000 and the adjusted cost base is $500,000, in other words, the total cost of acquisition is $500,000, the capital gain position is $20,000. So the inclusion rate is 50%. That means $10,000 is going to be taxable at the marginal tax rate of the individual. So if this individual is making $100,000 a year, effectively, they're going to most likely owe about $3,451 on a $20,000 capital gain. Okay, so if we factor in the total cost at death, again, we got to think about the cost of paying down the mortgage, and now we got to think about taxes. So add $400,000 plus the estimated taxes due at death, $3,451, and we get 403,451. So how do we calculate the estate value? Take the property value minus the total cost at death, and that works out to about $116,549. Okay, let's take a forward look and take a look at if the individual passes away at age 50 in year 2039. The capital gain is of course going to be increasing because the property value is going to be increasing at a rate of 4% annualized. And we have the same adjusted cost base. We'll just keep it at $500,000 for ease of example. Mortgage balance is continuously getting paid down. However, the taxes are growing because the capital gain position is growing. So in this scenario, we're assuming total cost of death, $288,830. And that works out to about a $647,660 estate value. Okay, so again, we really have to pay attention to the total cost at death to figure out, does life insurance make sense? And again, it's the same consideration as when we looked at the principal residence example. If we have any sort of cost due at death, the simple way to protect against this is by life insurance. So I just showed you the numbers. Now it's up to you to make the right decision to see if life insurance makes sense for your situation. If you want to learn more about this or you want to chat about your individual situation, I'll throw my contact information up on the screen. Feel free to reach out and I'd be happy to help.